Hello and welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Laurent Lequeu, also known as the Macro Butler. Laurent, how are you today?
I'm fine, thank you. It's my pleasure to be on your podcast, and I'm looking forward to this conversation.
Likewise, apologies if my pronunciation of your name was slightly incorrect there. French was never my strong point at school, so I apologise for that. Laurent, we loads to speak about today, and I think we'll probably start with looking at the generic macro situation, what's going on at the moment, and then possibly look at gold, silver, and if we get a chance, have a look at geopolitics at the end. What I would say for people listening, just to date stamp, because of the time difference, we're recording this late on Sunday, the 16th of March, uh, Mexico City time, and the podcast is out on the 18th. So hopefully not much happens on the 17th chart wise, but we will see. Laurent, let's start with your views of what's been happening in the last couple of weeks, because we've seen quite a steep correction, I'm going to call it, in the major US indices. Um, People calling for a rebound, other people saying, okay, well, maybe we've got another week of this. A lot depends on a Fed decision this week. What are you seeing at the moment? What are your thoughts?
Well, I'm looking at the financial world through the lens of the business cycle. So there are, in fact, three major market ratio to look at, and that is driving what's going on in the world. So if we look at the first ratio, which is the S&P to oil ratio, it's still above its 7-year moving average, but it has started to peak. So this means that, in fact, the US economy is slowly moving from an economic boom into an economic bust. The second important ratio to look at is the gold to bond ratio. I mean, this gold to bond ratio has been in an uptrend and above its 7-year moving average since the start of this decade, meaning that whatever government or central banks are telling people, in fact, the US and most of the world is an inflationary environment. So as of today, the US economy is still in an inflationary boom, but they are increasing look for a move from this inflationary boom into an inflationary bust, meaning a stagflation. And then there's another third ratio that is usually a leading indicator for what is going to happen in the economy, is the S&P to gold ratio. And this S&P to gold ratio, in fact, has been trending down since the early 2024 and has crossed below the 7-year moving average right on the day of the inauguration of the 47 US president. So usually when this S&P to gold ratio across below is 7-year moving average, is kind of a 6 to 9 months that we see the S&P to oil ratio crossing below the 7-year moving average, meaning that we could be around 6 to 9 months ahead into US stagflation. And of course, this will impact how to allocate portfolio and equity performance in the next 6 to 9 months and beyond.
Yeah, there's a lot to unpack there, and I know that given where we're at the moment, I've seen some commentators or people out there suggesting that that's it, we're in recession, we're these indices, the S&P 500, it's going to go down even more, might hit the 5,000 mark. I've then also seen people say, well, hang on a minute, we could have a blow off top, so we could get all-time highs, just it could happen, and then we drop off a cliff. Do you have any thoughts about the potential direction in the next 6 to 9 months before everything else kicks in?
Well, as I said, I mean, as of today, March 16, the US is still in an inflationary boom. But clearly, we have seen weakness in the US economy. I mean, if you look at some leading economic indicator, I mean, I'm not keen to look at official economic data, but but
Mhm.
there are clearly a weakening trend in terms of consumption in the US, and then you have Doge, which in fact is negative for the US economy, at least in the short term. So clearly, everything is pointing to economic slowdown in the US. And I go back to this S&P to oil ratio. So it has seems to have peaked. It seems that we are kind in a turnaround situation. As I said, the most important of these three ratio that I just mentioned is in fact this S&P to gold ratio, because it's usually giving a leading indicator of what's going to happen in the US economy. And when you start to see a monetary illusion, meaning that the S&P is rising in US dollar term, but
Mhm.
is declining in gold terms, in fact, it's usually a sign that the economy is going to slow down. So I think that what lies ahead in the next few weeks and months is that we will see a higher volatility in equity market.
Mhm.
And we will see a big rotation inside equity. So you may see the headline index declining, but you would most likely see a reallocation across sector, because when the US economy move from this boom to bust, it's usually a time where you see a lot of sector rotation.
Mhm.
And since it seems clear to me that we are not going into a deflationary bust, but into an inflationary bust, in fact, this would mean that we will see a big rotation from the energy consumer stocks into the energy producer stocks in the next few weeks and months. And of course, given that these energy producing companies are underrepresented in the headline index, you will most likely see the index trending down.
I know that you've written in a couple of recent articles, and I'll link to this in. I'll link to both of them in the Substack post that comes with the podcast, because two articles I'd highly recommend people read are the Stagflation Ides of March and also Silverbird. I'll link to your YouTube channel as well, because there might be people that prefer to listen to it rather than read. So my point being that I think in both of those articles, you mention that the Fed isn't really reactive as such. And I think a lot of people, the Fed are meeting on the 18th and 19th of March, so pretty much when this podcast is out. And I think Wall Street thinks the Fed might come to their rescue, but you're not so sure that they will, and they might have to make changes to the dot plot. Can you just go a bit more in depth into that, please?
Well, to be honest, I think that the Fed is completely important in the current economic environment. Because, I mean, if we go back at the source of inflation, it is mostly shortages that are creating inflation. And if the US government implement further tariff in the next few weeks and months, in fact, this will increase these shortages. And whatever the Fed does, increase rate or decrease rates, it will not really impact the supply of goods for the US economy. So to be honest, I feel that the role of the Fed has completely decreased over the past few months. And also, I mean, if we are moving into this kind of stagflationary environment, as my indicators are pointing to, in fact, the Fed is going to be cornered into a very difficult decision. Is
Mm.
what am I doing? Am I trying to stimulate the US economy by cutting rates, or am I trying to fight inflation by raising rates? So my view for this meeting is that the Fed will probably need to raise the dots.
Mm.
And to be honest, over the past few months, I've been in the camp that at some point the Fed will have to raise rates in 2025. This will most likely come by the second half of the year, because if you look at the Taylor rule, I mean, the Fed fund rate should be around 6%, not at 4.5%. And also, if we see the inflationary impact of the tariff materializing in the next few weeks and months, at the end of the day, the Fed, to keep at least a bit of credibility to the markets, we need to come back and make a big turnaround and probably raise rates. Also, investors must understand that, in fact, after the Fed cut rates since last September, the bond yields have been rising. It's only over the past few weeks that we have seen a pullback in long-dated US Treasury yields. So it shows that the market is not really looking anymore of what the Fed is doing. The market is just adjusting according to the data by moving long-dated yields. And I think that in an environment where you will see higher and stickier inflation over the
Mhm.
next few months and years, in fact, the long-dated yields are moving much higher by the second half of this year and in 2026.
You also wrote on the Stagflation Ides of March. I quite enjoyed looking at the graphic. Was the three faces of inflation. So you've just mentioned assets there and shortages, and you've also put down demand and currency, so public confidence. So if we see a confluence of all these three things, then I don't want to sound too dramatic, but all hell could break loose at some point if we get a really negative confluence of those three things. Is that correct?
Yes, I think that the current issue is shortages, but the public confidence is a big issue in terms of driving inflation. I mean, anyone who has lived in Latin America or in emerging markets know that inflation is driven by the low confidence that people have in their governments. And I think that this is going to happen in the Western world, in Europe, and later ultimately in the US as well. Because I mean, at the end of the day, Jerome Powell can tell everyone every month that is fighting inflation for the good of the American people, but I mean, the prices at the grocery stores keep rising, and he cannot do anything about the prices of eggs or the prices of meat at the grocery store. But this impact also the confidence that the people has in the Fed and in other government institutions.
In terms of people protecting themselves, because what I like to do on the show is, have a good chat about what's going on, but also come up with solutions. Now, I'm aware that, people that listen to the show are from all different backgrounds and will have different ideas. But I always like to provide or have guests provide solutions as well. And I think this is something we agree on. But you've also written that there are, despite what's coming down the road, and could be a bit of doom and gloom and high volatility, could be a rocky road. It doesn't mean it's the end of the world for you. There are things that you can do in order to protect yourself and actually benefit from this. What sort of things would you suggest people have on their radar in order to protect themselves and come out of the other side victorious?
Well, if I may kind of point to one solution to this upcoming stagflation, the solution comes on two fronts. First is to stabilize the geopolitical environment. I think that this is the first point because stabilizing and a more peaceful geopolitical environment will bring back confidence in a public institution, not only domestically but internationally, and also what we need, and I think that what Donald Trump is missing is that in fact, free trade is the solution. It's not tariff that is the solution. US companies went to set up factories in Mexico or in China, not because it was no, it's because it was much more expensive to do it in the US,
Mm.
and also it was because these companies wanted to benefit from the domestic consumption of these countries. So, I mean, the tariffs are not going to solve anything. What we need is we need free trade. We need peace across the world. And the third point that we need a cheaper source of energy, meaning that the drill, baby drill, in fact, is part of this of the solution, because I think that the mistake of the previous US administration was to constrain energy supply. And
Hmm.
we all know that, in fact, access to cheap and abundant energy is the solution to spread prosperity across the world for everyone. So I would think that these are the solution. Now, I'm in doubt that anyone in power in Europe or in the US will adopt this solution. So for investor, what they can do, in fact, to protect themselves, in fact, I personally think that the major risk is in the government bonds and
Hmm.
not in equities per se. So in fact, what investors should do, and if I come back to this business cycle, in a stagflation, history has shown that investors should own real asset, meaning physical gold, physical silver, physical platinum, or even commodities to protect themselves against this stagflationary environment. So in a diversified portfolio, everyone should have at least between 25 to 40% of its portfolio invested in real asset, meaning physical gold, physical silver, physical platinum, and other commodities. That would help them to navigate the rising environment, in the rising volatility in the next few years, and also the stagflationary impact on their portfolio. On the equity side, and in fact, I think that most investors are unprepared for what is coming, is that they should reallocate from the energy consumer into the energy producer, meaning that investor should forget the Magnificent Seven and focus on companies that are holding real assets or are producing real assets, so meaning the energy sector, the materials, the industrial of this world. And by owning these stocks, they will also, I would say, navigate the stormy waters ahead.
It's interesting that you mention mining stocks there, and it's a sentiment that I agree with because I was reading something this afternoon actually, and it was looking at a lot of the miners, and it's interesting that a lot of the forecasts are based on, I think it was 1900 or maybe $2,000 gold. And of course, at the time of recording this, it's around about $3,000, give or take a few dollars. So to me, that means that if mining companies look undervalued at the moment, and that's based on a projection of gold at 2,000 US dollars, when in fact it's much higher than that, then actually mining companies are going to be incredibly severely undervalued at the moment.
Yeah, I agree. I mean, the issue of the mining sector is the geopolitical risk that you take, right? So if you
Yeah.
own gold miners in the US, or maybe even in Canada, I think it's quite okay, because it's quite a reasonable geopolitical environment. But if you own a gold miner in Africa, I would think that there are a lot of risks that justify a discount in terms of valuation, because I mean, we all know that in the past, when the price of the commodity is rising,
Mm.
the government of this country are changing the rule of law and want to get a bigger pie of the profit generated by this miner. So I would think that in terms of miners, I'm more keen to look at miners of other commodities rather than gold, because I
Mhm.
get exposure to gold and silver by owning the metal itself. And I see, in fact, more opportunities in mining stocks, in other metals like copper, iron ore, and nickel. And I think that, again, here, what I want to point is that if the geopolitical environment remain unstable, as I mean, we unfortunately can expect, in fact, we will see a higher demand for a lot of metals like nickel or copper. So on top of this, all these miners, I'm not giving here, I would say, an investment recommendation, but base metal miners are also grossly undervalued. And what the markets and what investors are missing is that, in fact, since the start of the year, the Bloomberg Commodity Index has outperformed almost all asset classes. And if you dig deeper into the Bloomberg Commodity Index, I mean, outside the precious metal is the industrial metal that have done very well as well. So I think that there's a lot of gloom around the mining industry, but in fact, I think that I see a very good outlook for this industry. On top of this, I mean, the big player in the industry have kind of rationalize their business and also have improved dramatically their balance sheet. So, I mean, they have learned the lesson of the previous boom and bust in the sector by reducing leverage and being able to generate free cash flow at much lower price of metals. In fact, now they will be highly profitable in the next commodity boom.
Absolutely. And I think it was with Don Direct a little while ago, and he made the point actually that when it comes to mining stocks, and I appreciate, as you say, this isn't investment advice, this isn't any recommendations. There's loads of companies out there, always do your own homework. The point he was making was that if you look at everything, how it's playing out, geopolitical tensions, financial issues with balance sheets around the world. His point was if you believe in your heart of hearts that gold and silver are going to go to, you know, X amount of dollars, the chances are the miners are going to benefit greatly from that because, yeah, as we said at the start, as well as I said about 5 minutes ago, a lot of things that I've seen, they're all based on very low targets in gold and silver, where of course we're sat here and I'm sure that we would agree that at some point, given the commodity cycle that we're just about to go through or that we've started going through, the chances of gold hitting $5,000, possibly $10,000, it's quite possible that that's going to happen. So if you're a mining company, that's just more profit for you. So yeah, I echo what you've just said. I think it's very prudent that if people do not have exposure to mining companies, that they should start doing some homework on them.
Yes, I completely agree. I think that what we must understand is that, I mean, and I still look at what Wall Street try to convince its investors is that miners have been unloved and underowned for many years. And
Mhm.
one reason was also because the ESG scam that I call it the ESG scam, meaning that in a ESG world, you are not supposed to own any mining companies because what they do is supposed to be a dirty job. But in reality, I mean, everyone knows that everything that we have, everything that we wear is related to oil or one
Mhm.
metal or the other, right? So I mean, at the end of the day, we are not living yet in the metaverse, and we still need a lot of commodities every day to live our everyday life. So I think that a lot of investors will need to have a shift in their mind in the next few weeks and months. For some, would be very painful because they will most likely keep buying the dip of the Magnificent Seven, while as I said, if we are heading into this inflationary bust, in fact, they should buy the dip in everything that is producing a commodity.
Totally agree. Talking of commodities, one commodity that you mentioned a little while ago, and I appreciate most people listening to this are going to know gold, are going to know silver. A lot of people might not know about platinum. I started putting that on my radar. So, the weekly newsletter, I started putting some charts of platinum up on there. And you mentioned it in terms of potentially having a physical allocation. Uh, if you can, let's just dive a bit deeper into platinum. Why, why platinum? What qualities does it have? And what do you see the future in platinum? Where do you think it could potentially go?
Well, I mean, if you look at the supply side, I mean, it's mostly dominated by Russia and South Africa. So, I mean, on the supply side, I think that there's clearly a geopolitical kind of tilt that could drive prices higher, meaning that if Russia and South Africa decide to restrict supply, this would inevitably have a positive impact on prices. On the demand side, I mean, outside jewelry and investment, platinum is mostly used in aerospace and defense. So,
Mhm.
in fact, uh, platinum is driving well nowadays in terms of the demand related to the geopolitical environment. And I think that if you look back at the price in dollar terms, I mean, historically, platinum happened to trade at a premium against gold, which is not more the case anymore.
Mhm.
And again, here, I mean, the reason that we have seen the sharp discount of platinum has been that in the past it was widely used in the automobile sector, and since everyone tried to convince us to move to an EV rather than to a combustion car engine, this has been the negative for platinum in terms of demand. But I think this is well known by investors. So I mean, I don't think platinum is for everyone because it's much more volatile than gold and even silver. It's much more difficult to monetize in terms of if you want to monetize the physical platinum, you will get much more difficult to do it than if you want to monetize a silver coin or a gold
Mhm.
coin. So this is not for every investor, but for investors who are building their position in this real asset or precious metal, I think it's part of this portfolio of precious metal that everyone should own. And I mean, it also depends of the risk aversion and also how investor can stomach the volatility of this precious metal. So I'm not recommending platinum for everyone, but I would think that in this 25 to 40% allocation to precious metal and real assets, everyone should own at least 1 to 3% of platinum.
Thanks for clarifying that. I think that's incredibly useful. As I said, I'm sure most people listening are going to have that allocation to gold and silver, but platinum might not have been on their radar. Laurent, one question that springs to mind, if we could just touch very briefly on uranium, and then we'll go into geopolitical challenges, because obviously there's a lot going on at the moment. Just reference to back to what you said, you obviously mentioned about energy, and yeah, energy is the economy, and the cheaper energy we can have moving forwards, I think the more prosperous, the world is going to become. A lot of people listening will say, well, Rob, that, or Rob, Laurent, that's got to be nuclear energy because of the power that has. What are your thoughts on, if you have any, what are your thoughts on uranium and or uranium miners, if that's something that you look at?
Well, I think that uranium is part of the solution for abundant and cheaper energy, but it's not a one size fit all for every country. And so I think that we need to make a distinction between the US, Europe, and let's say Asia and the rest of the world. So in the US, in fact, the cheaper energy and the most abundant energy is natural gas, is not uranium. Because if you look at where is uranium coming from, it's coming from Russia, it's coming from Kazakhstan mostly, which are not really friendly countries to the US. So if you are a US investor, in fact, and that's what I think that the drill baby drill makes sense, is that the solution for the US is to use is cheap natural gas as a source of energy and to fuel its economy. So from a US point of view, I would think that uranium is not going to provide the solution to the energy cost problem. But from the European point of view or from the Asian point of view, I mean, it's a bit different because Asia and Europe are not blessed like the US with abundant source of natural gas and oil. So they will need to look for an alternative. And the alternative is clearly the nuclear power and uranium. So again, and that's what I think that you have seen a lot of development in terms of research in China and in India and in other emerging markets to try to use uranium as a reliable source of powering the economy. Europe is not there yet. Unfortunately, most of Europe is still, I would say, driven by the greenwashing policies. But the solution for Europe would be to move back to nuclear power. I think one of the mistakes that France made was to close down most of its nuclear power supply. I mean, it's a political decision. I'm not seeing that Europe is keen to drive back. If I read what the new German government is looking to do is the new German government is looking to build a natural gas power station to solve its energy problem. But unfortunately for Germany, I mean, in the past, they could buy cheap natural gas from Russia, which seems like unlikely to happen again anytime soon. So, I mean, if the new German government goes ahead with this natural gas source of supply for its economy, I mean, it would mean that they will have to buy natural gas from the Middle East or natural gas from the US, which will be very expensive again for them. So I would to circle back to uranium. I mean, I see a big source of demand coming from Asia in terms of uranium. In terms of uranium miners, I mean, most of them again are having their mine in very exotic countries, which personally I'm not always keen to get exposure to. So I think that uranium miners are a speculative investment for those who want to bet on higher uranium demand. But at the end of the day, I think that we will see a much higher demand coming from Asia and emerging market rather than from the US.
Thank you for going in depth on that. I think that helps to clear up a few things. I've certainly been making mental notes. You might have seen me with my pen there scribbling down. That leads us on to geopolitical challenges then. So a question I wanted to ask you beforehand is, well, we were discussing off air. I've recently moved from the UK to Mexico, so currently in Mexico City, and it's interesting looking at the news narrative. So obviously, being in the UK, obviously there's a lot of news about the UK, the EU, Russia, etc. Moving over to Mexico, a lot of it's about relations between the USA and Mexico. You don't really hear a lot about anything else. Um, Obviously, I won't give away where you are just in case you don't like that. But over in Asia, shall we say, is there a lot of talk about China and Russia over there. What's the geopolitical landscape over there at the moment? Is what is happening over there different from what's likely to be reported in other parts of the world?
Well, I think that I want to take a step back of what happened since 2022. So, I
Mhm.
mean, in 2022, when we saw this rising polarization between the West and Russia first, and the rest of the emerging market, we kind of started a new era. And the mistake that was made by the previous US president was that he was able to create the alliance between Russia and China. I mean, historically, Russia and China have been big adversary over the centuries. And
Mhm.
what happened post the start of the special operation between Russia and Ukraine is that you have seen the alliance between Russia and China. And by creating this alliance between Russia and China, in fact, the previous US president has allowed to combine the access to cheap source of energy from Russia with the manufacturing capabilities of China. So
Mhm.
now China and most of Asia and emerging markets can get access to cheaper energy. I also take the example of India, which in the past was buying very expensive oil from the Middle East in US dollar. Now most of oil in India is supplied from Russia and can be bought in rupee. And this also has solved a lot of problem for India in the current environment. So to circle my thought is that in fact the previous administration kind of create the alliance between Russia, China, and India, meaning that they combine the access to cheap source of energy from Russia with manufacturing capabilities in China, and then a rising consumer market in India. This alliance of these three countries is clearly unbeatable. So if we move fast forward to Donald Trump, what he's trying to do, in fact, I guess he's trying to break this alliance because he has understood that the alliance between Russia, China, and India will ultimately dominate the world in the next decade and probably also the next century. So what he's trying to do is to bring back Russia from into the Western world and kind of break this three-country alliance. But unfortunately, I mean, I still follow the news in Europe. Unfortunately, I don't think that the Europeans are very keen to support Trump in this initiative. And I think it's a big mistake because, again, Germany was able to be very prosperous because it was able to get access to cheap natural gas from Russia. We
Mhm.
cannot deny this.
Mhm.
And we have
Yeah.
seen that since 2022, Germany and the rest of Europe have declined because they are not able to get access to cheap energy anymore. So I think that the key in the next few weeks and months is to look if uh, the US and Donald Trump is able to bring back Russia into an alliance with the Western world. On top of this, and I think that is also underreported by the financial media, the European governments are in a very difficult situation. I personally think that most European countries are on the edge of a sovereign debt crisis.
Mhm.
Um, and the European governments, in fact, face a lot of problem of credibility. If you look the past elections, in fact, most of these elections have kind of been confiscated by governments. If I look at France, if I look at Romania, if I look at even Germany, I mean, if you look at the latest German election, the AfD, which is looking to, I would say, to break up with the euro, and which is looking to go back to the old German manufacturing style of growth, has been put aside by the traditional party. So, I mean, in this kind of environment, if you are a prime minister and you have a very you are not really getting the confidence of your people. In fact, the best way is to create an external event, and that's why I can see that a lot of European countries are looking, in fact, to tighten the war situation in Eastern Europe, because it's a way for them to avoid to discuss all their domestic problems, and it's a way for them to stay in power.
Yeah, a lot to unpack there. I know that, but first of all, actually, just want to quickly mention natural gas because you mentioned it a few times. I was looking at, I think it was an article by Doomberg, looking at the amount of reserves that they have in the EU at the moment. I think it was about 36%, which might sound okay, but if you look at an historical graph, the fact that they've actually got to, well, they should replenish those reserves at some point this year. I'm not saying that natural gas is going to go to the moon, but if you just look at what could come down the road in with what you've just said about what EU countries are looking to try and do as well, i.e., they are trying to force a hot war. Let's be honest, that's what it looks like they want to do. Just putting those two factors together, that could lead to much higher natural gas prices, potentially a spike up this year. Again, going back to what you've just said, yeah, it's scary. I think it's also very interesting from the point of view that, as you say, Donald Trump to me seems like he understands the situation and he's going to try and get Russia back into the game, so to speak, and to, you know, re uh, reignite ties with the West. And I think he might do that. Now, he might do that in terms of US-Russia relations, and that is completely possible. But like you've just said, if we actually look at what's going on in the EU, and I look at the news as well every now and then, um, I don't like saying this. If we're being realistic on the program, which we have to me, it looks like there'll be a hot war because, as you say, with a sovereign debt crisis, you need to create that diversion, and it looks like that's what they're trying to achieve for the continent of Europe, which is obviously mad, but this is history repeating itself, is it not?
Well, I think that unfortunately this is the most likely outcome of these events, right? I mean, even you look at the latest budget from the new German government. I mean, it is increasing spending and focus on defense. I mean, you don't build a sustainable economic growth and a prosperous economy by spending money you don't have
Yeah.
on defense. I mean,
Mm.
this is not a long-term sustainable path for an economy, right? So even this new German budget is telling you that the new government is desperate to trigger a hot war in the region. And I mean, for the people listening this podcast from Europe, one advice that I should give them is to get out of Europe in terms of not owning any asset in Europe, or not having their savings in Europe, because when the hot war starts, in fact, you will see the implementation of capital control, and you will see governments like requesting for these savings to be put at work to contribute to the war effort. So, I mean, in France, I take this example. There are a lot of signs that the government will ask people to use their money on their saving accounts, the livret A, to use that to finance the defense spending. I mean, these are not going to be a long-term and sustainable path of development for these
Mm.
countries. So, I mean, for listeners from Europe, they should not have anything custodized in Europe.
I know I've said in the last 45 minutes I agree with you a lot, and I'm going to say it one more time. I agree with you 100%. And that, again, that was part of my reasoning for moving from the UK as well. It was one of the darker reasons for moving. Yes, my wife's Mexican. Yes, we're in Mexico City, etc., etc. But actually looking at the geopolitical landscape, that also helped us when we were deciding what was best for us moving forwards. And when we were deciding between the two countries, that one of the reasons I pushed for Mexico was that actually, our politicians are in a state of trying to drag us into a hot war. And also, going back to an article last week, I think was it 10 trillion, I think, euros in savings were going to be put aside for defense spending. I think it was 10 trillion. I'll try and find the article and link to that. So again, as you say, these should be sending warning signals. These are giant red flags. If you have the ability to do something, have plan B, just like you've got plan B, just like I've got plan B. For people listening, if you've got that ability for plan B, I think it's fair to say we would both urge you to go and get started with that as soon as possible. Uh, don't wait because it might be too late.
Well, you have already seen the money moving, right? I mean, we have seen this big outflow of physical gold and even physical
Mm.
silver from London and Zurich into the US and into Asia. So I think that the smart money is getting ready. And I advise everyone, I mean, I know it's difficult sometimes to leave the place where you grew up or to leave your country, but you need to have a plan B. And I think that nowadays, especially for people in Europe, they should have some asset custodized outside the Eurozone. I mean, depending of where you want to live or what are your future around the world. There are different places in Latin America, in Asia, where you can, I would say, be safer than in Europe. And I think this is one of my recommendations that I give to anyone that who wants to listen to me. I always say you should have plan B and even maybe plan C. And this time for European people, it means that you should have some asset custodized outside Europe in general, meaning include the UK and the whole Eurozone and also, I mean, the whole EU in general.
I think that's a very good place to wrap up this podcast. And there's a lot of practical information, I think, for people to take away, a lot of action points, I think, for people. There's a lot coming down the road. I always like to give people the opportunity to say how you can be found and how people can get in touch with you. So the floor's all yours, Macro Butler. How can people find you? How can people get in touch?
Well, I write a weekly newsletter on Substack at the Macro Butler, so people can find me there. I also have the Macro Butler YouTube channel. It's just audio version of the weekly newsletter, and then I advise high net worth individual and anyone who want to contact me can send me an email at info@themacrobutler.com. And I wish everyone to be safe and everyone to be wealthy and healthy in their life.
Laurent, aka Macro Butler, thank you very much. It would be an honor to possibly catch up later on in 2025, have a look at the lay of the land and see what's going on. And all of the links that you've just mentioned, I will put a link in the show notes or in the Substack article that comes with this podcast. Thank you very much for your time and look forward to catching up later on in the year.
Thank you very much, and looking forward to be on the podcast later this year again.